you've met the panelists here, so I'll be very brief because I want to dive right into the discussion. I only wanted to say really that we did do some research on the area of stablecoins. We were, I think, the first to publish a major empirical study, first in September of last year, and then also a follow-up this year, looking at dozens of different stablecoins like Monerium and others, even ones that don't like the term stablecoins. They don't like to be called a stablecoin, which is interesting. But we rated the stablecoins across a number of metrics: how transparent they were, how complex the stability mechanism is, how automated the stablecoin was, whether or not the stablecoin featured some type of upside participation, which is something I'd love to talk more with the panel about. So basically, does the stablecoin system offer a way for users to benefit from the growth in the system financially through some kind of additional token that's a part of the system, the maker token and the maker DAI system being an example of such a system, or some other way. We just saw a group announce a US dollar-backed stablecoin this week, I think, that's going to actually share some of the returns that are earned with users of the stablecoin. I'm forgetting the name of that, but I think it's one of the first examples of a fiat-backed Tether-like stablecoin that's actually going to be offering returns to users. But one thing we did not do in the report is try to grade different stablecoins across by their level of decentralization, because that's a little tricky to do for various reasons. Certainly things like how automated a stablecoin is, how transparent it is, are the assets that are backing it on a blockchain. These are all things that can maybe factor into some type of decentralization rating, but it's a complex subject, decentralization, and maybe one that we can get into here with the panel. So anyway, download the report if you're interested in reading more about it. But without any further ado, let's kick things off. My first question, I guess, to the group, whoever wants to tackle it, is stablecoins aren't new, as was discussed. Tether's been around since I think 2014. But obviously with Libra, things are really accelerating, a lot of attention being paid to this area. What is, in your view, kind of the current state of play with the advent of Libra? Where do we stand? What are things that are stablecoins are doing well today? Where there's still big deficiencies and things that need to be improved? And just kind of what's the general state of play? Who would like to? Danny?
I'll kick off a little bit. I don't know if this thing's working, but
I can pass this down.
Yeah, all right, let's do that. I'll just touch on the Libra thing for a second, because I think that, in my experience in crypto, there's a ladder of people who understand crypto. It started way back with some adventurous speculative types, and then to small hedge funds and larger investors, and now institutions. And at each point, there's a second ladder of understanding, and that understanding is, how much do I get crypto? Do I believe it or not believe it, like it or not like it? And those ladders kind of overlap, and as you get higher up the ladder, so you get higher up the understanding, and it's a process for everybody. What I found encouraging about the Libra announcement is that all of a sudden, having come from very small beginnings, as this community did, the President of the United States, the Secretary of Treasury, the Chairman of the Federal Reserve are all talking about electronic wallets, cryptocurrencies, networks, and I found that part to be a great positive. And again, here we are at the offices of blockchain. We all know the great wallet growth that this company's had over the last few years, number of years. But it's still a very small number. 40 million compared to 2.7 billion is a 1.7 billion, whatever it is, huge number that Facebook have. The potential travel into a whole new community and exposure to digital assets and wallets was a great positive. But as you saw, in fact, our Chief Strategy Officer, Melton Demiras, who I'm sure is known to a lot of you people here, testified on the Hill for a number of hours and had commented in writing. We commented in writing as an organization before that. And we don't really think, Facebook is a cryptocurrency in the sense that we believe it is. It also attempts to do a lot of things I would never attempt to do, which is, there's a big regulatory morass in the world that depends on which country you come from or what type of product you're trying to list. Is it a MiFID transferable security? Is it a collective investment fund scheme? Is it within the banking regulation? And there are many, many others. Each country or part of the world probably has some sort of different legislation. It's different for assets as it is for fiat currency. And so when you're looking at Libra, it's part fiat currency, it's part assets, it's in multiple countries, it's sold in multiple countries, it's used in multiple countries. I personally think it's a regulatory a bird's nest that you can never unpick. I just don't see the people actually practically getting together to do that. Add to that the fact, Facebook is coming to that party from a rather unfortunate place given the privacy issues that they've had and other sort of unsavory things on Facebook. So for me, Libra, good headlines will never be delivered.
Anyone disagree?
Well, I'd venture to say, just from a slightly different perspective, that there is no such thing as a stable coin. There's no stability in the financial system any more than there is in the universe. If you want to take a philosophical perspective, we live in an expanding universe. We're basking in the glow of a great nuclear oven in the sky. The Earth's crust is moving and expanding in places like Iceland in volcanic eruptions. We humans who have been living here for 50,000 years in current form on this planet Earth, we create institutions. And we try to impose stability on interactions in certain ways that where we like to have stability. And so central banks are created for the purpose of having some sort of stability, some sort of reference point in the financial system. They are, as the name indicates, they're the central bank, they're the bank of the banks, as Robert described. They intermediate between the banks, they create money, their liabilities are not redeemable. On the opposite side, you have a chain of signatures, which is a coin, which is something completely novel, which sort of makes people scratch their heads. So we're approaching the problem of linking fiat to blockchains, not from the chain of signatures point of view. We have a very clear legal framework which predates cryptocurrency, which predates blockchains, which is supposed to be technically neutral, which is not, unlike some of the fiat-linked coins, an ad hoc user agreement of a private company. We follow a format or protocol, which is in society, a big society called the European Union, been in use for almost 2 decades. This is as close to stable as you can get within the fiat system. And I'd venture to say also that it's decentralized because unlike Tether, we're quite transparent versus the regulators, the auditors. There's a separation of function. There's a clear protocol for how we can safeguard users or customers' money. So if there's any decentralized form of fiat, I think e-money is it. With regard to Libra, I'd say that our philosophy is quite different. We like to move fast, but not with. We don't like breaking things. Money is too important to be broken, and the right way to approach money in society is not to try to impose your ad hoc standard on society. The right way to approach this is to have a conversation with, at least in the democratic countries, I'd say. Never mind Venezuela for the sake of argument, but the right way to approach this issue is to have a conversation with the authorities. The conversation should be about what standard is appropriate, and it should not be trying to impose political pressure to impose your own standard. Unlike Libra, we don't, for instance, intend to impose a currency basket on our users. There's no way we can understand how our users would want to create currency baskets. I think that is one reflection, is one evidence of how the poorly constructed the Libra approach is, that they even contrive to think of a currency basket that would be relevant to a wide group of people, that violates something which is known in economics as an optimal currency area. What is the optimal currency area of Libra, might I ask? We'd rather issue, for example, individual currencies or e-money denominated individual currencies and let users construct their own baskets using their own smart contracts. So we're a building block. We're for other people to construct their own services And we don't serve the mainstream users as Libra says it will, especially not in the developing countries, as it were. So that's just my 2 cents on stable coins in general, and then drilling down to Monerium and down into Libra, how we're different. And handing over to Robert.
Your thoughts on kind of what's happened since you wrote the Senior Shares paper? Where are we today with the whole space? Yeah.
Oh gosh. Okay. Yeah. So yeah, on the Libra thing, I mean, I agree with Sven. I think that about the idea of creating your own unit of account is really a bug rather than a feature. Is a really crazy design decision there. I agree with Daniel that the legal implementation of this thing is enormously complex. There's no way it's going to go live within the timeframes that they're looking at, if at all. But I think the thing that's the reason why it is significant, though, you know, when the announcement came out, and there were probably read lots of stories about the central banks meeting together, and you know what they're going to do about the Libra threat, and you know, I don't really think the central banks and the policymakers particularly feel threatened about the Libra project. The reason it's important is that there's actually a lot of stuff that has been sort of baked into the pipeline of the monetary order that we've got today that kind of started after the great financial crisis that hasn't really been resolved. And Libra was like an opportunity, like a focal point for the central banks to start showing their hands in terms of which direction of travel they're going to go down. And there isn't a sort of common global view on how each currency area is going to change. And I think that's the real story that's going on behind the scenes, and it goes well beyond you know, cryptocurrency and stable coins, and certainly Libra.
Great. So in terms of where we want to go next, we haven't talked about, a lot of the discussion where we are today is obviously that the fiat-backed stablecoins are dominant, you know, in the space. Tether, incredibly resilient in spite of, you know, attacks from the New York regulators, disclosures about, you know, loans that were going on behind the scenes, has doubled in size since all of that. But you know, there are advances that have been made from the simple fiat-backed model. If you want to call them advances, I guess we could debate that. Something like the make-or-die system, which is using crypto assets to back a stable coin. What are your thoughts on that model? You know, there's obviously big trade-offs with, you know, needing an asset to back it and how quickly it can scale. But is that an improvement, you know, in trust minimization and automation, or what are the deficiencies? And is that something you can see kind of growing as time goes on? Who wants to comment on the crypto asset-backed stablecoin model? Yeah.
Not really.
I really support like the efforts of MakerDAO, which are sort of honest and transparent, and intended to be experiments in issuing money, using money, that are try to sort of do it in a shall we say, a way that is not intended to disrupt society. I think MakerDAO and DAI are very interesting, but it will take a long time for many of these currencies to find use cases and gain use, because money in itself is essentially sticky. There's strong network effects in the fiat system, and you need something radical to get people to start using a different form of money, like Bitcoin. Bitcoin was sufficiently different, and so it had so many different characteristics from the usual system and it was, shall we say, very cleverly sort of launched, that I think Bitcoin will be around for a very long time. And then there are varieties on Bitcoin. There's like forks of Bitcoin, as it were, or the technology. And one of those experiments, which I think is being done, you know, in a very sort of transparent, honest way, is MakerDAO. So it will find a use case, I hope, and possibly a use case that is not served by fiat.
Robert, any comments?
Yeah, I agree. I like the MakerDAO project as well. regardless of the design of the thing. I think the integrity of the team and the thought that they put into the development of it is impressive, and what you need to see to have that concept of an algorithmic stablecoin progress. I mean, there are a lot of projects that are, launching, similar ideas, all kind of variations on a theme, without a lot of the underlying R&D that's needed in order for something like this to be possible. In a way, it's kind of depressing. I mean, I think back in 2013, 2014, when it's a very small group of people who were researching the space, there actually hasn't been much fundamental progress, I think, in terms of trying to solve the whole hard problems to make it work. But my own view on it is I think, it's when you said something interesting when you were talking about, money is kind of a social construct, and there are no stable coins, nothing's actually stable. There actually is there's an interesting analogy between the central bank money and a cryptocurrency, which just like central bank money is not redeemable and it doesn't have credit risk, unlike commercial bank money. A cryptocurrency doesn't have, it's not a liability of anybody. And it also it doesn't have credit risk. So the idea of having a cryptocurrency that has a flexible, kind of elastic supply, it's baked into the protocol of the system, so it can have the stability to act as a unit of account like fiat currency. That's a very, very powerful concept. It's also not that radical of a concept, because it's really kind of like saying, taking kind of monetary ideas from monetary theory and just taking a position on it and saying, well, whether we have central bank or not, the monetary policy should be driven by rules rather than discretion, rather than a bunch of guys getting around the room and deciding whether or not to increase the money supply and change interest rates. So the idea of kind of rules versus discretion, which is an old idea, and taking the rules side of the debate and then saying, and then let's implement it in a way that's all in a protocol and decentralized, is actually not that radical of an idea. So I think the longer term promise of algorithmic stablecoins is actually very great, but I do think there are hard problems that still need to be solved, and I think for it to be practical and operationalizable, I think there's a lot of infrastructure that on the technology side, particularly in peer-to-peer networking, et cetera, that needs to happen first. I don't think it's the stable asset that will, an algorithmic stablecoin that happens first, and then the Web3 vision, grows out of that. I think it's more of, the Web3 vision gets implemented in a variety of different ways and adopted, and eventually, when the central banks screw up and price stability becomes unmoored, that there will be adoption of an algorithmic stablecoin. But I think it's not a near-term thing.
Danny, yes.
Yeah, interesting thoughts. But, when we're talking about asset backing, of any kind, and you're looking very much forward to the new systems, the new adoptions, Web3, this kind of stuff. But I think you can look backwards as well. We're involved in a hard asset tokenization platform, which everyone will hear more about in due course. And I think that real assets, really safely stored, segregated real assets, are an interesting throwback to essentially, the gold standard, i.e. a new version of the gold standard. That is not a fully functioning money system as we know it today. There are many other aspects to it. But I find it quite an interesting thought experiment to think to myself, well, if I had a gold token with very secure gold, and a silver token, and a timber token, and an art token, and a wine token, and I combine those as my portfolio, and that stuff is spendable and exchangeable for dollar-based goods and services through some other intermediary like a BitPay or somebody, then I've got my own version of asset-backed money at that point in time. And especially after listening to Rob and the vague constructs of what fiat money actually is, and what we also know about the state of central bank balance sheets these days, and the possible lack of an exit strategy, because we don't know what that is yet. To me, the concept of asset-backed money is very, very interesting.
So just on that point, there's a few directions I want to go. I want to come back to seniority shares at some point, maybe talk about basis and some of the other kind of next generation attempts at building new types of stable coins. But on this asset-backed issue and kind of the one of the interesting things about Libra was that it's going to include not just the 5 currencies they've mentioned, but also some short-term debt, as I understand it, some of which may be having a positive yield and earning, interest and growing the value of the portfolio. And I just wanted to hear the panel's thoughts on, the idea of a stable coin that's actually appreciating in value, or is at least holding its purchasing power relative to, say, the US dollar or a fiat currency, and what that could mean for the adoption of a currency that's, at the bare minimum, holding its purchasing power better than a fiat currency, or maybe even growing in value. And this goes back a little bit to Hayek and his denationalization of money thesis, where Hayek in the 70s, I think around 1980 almost, right, wrote this book, pamphlet really, on how he was arguing for the return of currency competition and privately issued currencies. But his theory was that the currency that would win in this world of privately issued currencies would be the one that was the most stable. And some have suggested that people would rather actually own something that's doing this over time, rather than just doing this. So thoughts on that? Would you rather own a currency that's, maybe bumping around a bit but going up? And also just on the idea of something that's actually holding its purchasing power better than fiat, which Libra may be an attempt to try to do. Is that something that could work? Anyone want to?
I mean, like, who wouldn't want an asset that goes like that? It's stable and it just goes up. I mean, there's kind of like, fundamental fundamental of life and risk and financial markets is that there's no risk without return or no return without risk. So the idea that you've got to decide what it is that you want the asset that you use as a medium of exchange and to settle debts and to transfer value to be an investment or something that's used to transfer value. And the kind of dual role that money has as both a store of value that earns some interest if you put it in the bank and will lend money to the bank and take on the credit risk, but is also used as a means of payment, is a bit of an accident. There's nothing necessarily connected between money as an investment and money as a means of payment, medium of exchange. And I think if you try to construct a system where you hey, I've got the stable coin and it's going to give you a better yield than treasury bills, but it's also going to be stable, well, how are you going to do that? Because the only way you kind of get the stability is to get someone on the other side who's absorbing the volatility of the changes in the demand. And if you have something that is an attractive thing from an investment proposition, you're going to get demand that's investment demand. But investment demand is a very unstable thing. It goes up and down all the time. Whereas transactional demand, that is a stable thing. It kind of grows with GDP. So if you want to construct a stable coin, it's going to have to be the worst yielding asset around. And I don't think that's a bad thing. It's a good thing. It's not supposed to be your store of savings. That should go into stocks and bonds and capital investment. It should be high velocity, temporary store of value that has a lot of transactional utility. That's my.
I'll give that. Look, I'm not an economist by any means, but I did do sort of A-level economics, and from what I recall, the interest rate was essentially the cost of money. So I want to go do a business, I have to pay interest to borrow that money. I want to buy a house, I have to pay interest and borrow that money. And it's pretty interesting that through the financial crisis and in the last 10 years that we've been dealing with the consequences, interest rates have been going down and down and down, and they're really going down hard now. We have $17 trillion of global bonds yielding negative. Euros, Swiss francs, all negative. You pay money to give someone your euros. So I look at this very simply and I say, clearly there's not very much demand for money, or alternatively and more likely, there's a tremendously high supply of money relative to the demand for that money. And then you look at something like Bitcoin, and I know it's not a stable coin by any means, but it's a currency. And you have this really healthy interest rate. And it's quite interesting to try and figure out why Bitcoin has an interest rate. And it has an interest rate because there's a lot of demand for Bitcoin. And I'll tell you exactly where that comes from. Things like GBTC, Barry Silbert's Bitcoin Trust. Because there's so much demand for GBTC that it trades at a 50 or 100% premium to the price of Bitcoin. So in order to rectify that, you go and create more GBTCs. And you have to do a creation with Grayscale in New York. And then a year later, you get these certificates to become freely tradable. And you can collect that premium. And the way to do that trade most effectively is to do it by borrowing the Bitcoin rather than buying the Bitcoin. So that what you're effectively then doing is trading the spread between what you borrow at and what the premium on the GBTC instrument is. I know that's probably very complicated for the non-financial people, but it's a source of borrowing for Bitcoin that generates an interest rate for Bitcoin because there's more demand for Bitcoin in that particular market segment than there is supply.
Just my quick take on trying to mix together stability and return is that it sounds a bit like some of the Icelandic banks, 2007, 2008. So what they did offer in this country was a very high interest rate on deposits. And then everything regrettably went bad. And the deposit was supposed to be insured, and it turned out the insurance was inadequate to cover except a small amount for each account and each individual. Prior to Jon being appointed to the board of the Central Bank of Iceland, he and I were involved in a campaign in Iceland to try to prevent our government, the EU and the British government, to try to make the Icelandic taxpayers pay for these liabilities that came about as a consequence of these Icelandic banks raising money in the UK by offering too high interest. We can tell you a lot about how deposit insurance is insufficient in many cases and utterly inadequate in other cases. But the main lesson from that is that it's very scary when somebody presents you with a combination of high return and stability, especially when you don't know what's behind it. Like JP Morgan balance sheet, do you really know what's on there and how it behaves in different circumstances, different scenarios? I'd be highly skeptical of trying to mix the two. I'd rather hold whatever 50-50 fiat and Bitcoin and keep everything sort of clear, clean cut and clear.
How are we doing on time? Maybe one more question and then go to the audience. So we've got a very sophisticated audience here. You mentioned on seniority shares and kind of the more advanced efforts. There hasn't been a lot of progress since 5, 6, 7 years ago almost. What progress has been made with some of the ideas that you were part of developing? What is your reaction to projects like Basis, Ample4, things that are kind of been out there recently? And where does someone who wants to work on things like seniority shares kind of, where should they focus their attention and their energy?
Sure. I think there's been a lot of progress in like related stuff, and I think like where to get into it is to think about stablecoin not as just like, okay, we implement it as a series of smart contracts in the Ethereum blockchain. It's a token. You got 2 tokens. To actually think of the economic mechanism of the system as a whole. So, and that really wasn't covered in trying to cover in the seniority shares paper. But the craft of mechanism design and designing a blockchain, which gets into how you make your consensus protocol, incentive compatible, et cetera, the kind of microeconomic aspects of it are highly relevant to the kind of more macroeconomic aspects of trying to create a stable coin. So I think like combining the research, and there's a lot of, and there has been a lot of progress. There has been a lot of progress in the mechanism design aspect of blockchain systems, and I think kind of approaching the stablecoin thing from that perspective is where we actually get traction. The other problem that is is the one of how to represent facts into the outside world, into a blockchain system in a trustless way. That's a really interesting problem and a really hard one to solve, and I don't think there has been a huge degree of progress on that. But it's an interesting problem, and it's one of the ones that if you can solve, it enables lots of things, not just the stablecoin idea.
Yep.
Spectrum with more than one dimension.
Multi-dimensional spectrum, yes.
My answer would depend on whether you're going to join the fight on coinshares.co.
I'm already actually for a while.
Excellent, it's a spectrum as well. A good kind of middle ground case is the Revolut app. You know, the Revolut app is a PSD2 beneficiary because there's no other way Revolut get access to my bank account other than through that system. It must pain HSBC to do that. But, you know, I had an HSBC account 25 years ago and it looks exactly the same as it did back then, give or take. So they had their chance, right? So here's Revolut, and, you know, as you get in the Revolut app...
They're still MasterCard, right? They use MasterCard.
True.
Now Visa, actually.
You know, there's going to be connections for some time, I agree, but the simple fact is it's one of the first things I've seen in a payment system that actually delivers me a materially better impact, and I'm doing the best I can to migrate off of that alternative. You know, I think in many ways the hurdle is very low in terms of moving on. By the way, did you fill in the question? Join the fight, coinshares.co.
No, I'm all for fights, making legitimate instruments available to the public in a regulated way, so please join the fight. And thank you. So shall we say, no, we're not targeting Joe on the street. The PSD2 is a great way to sort of promote unbundling of banking services. We support it in general. We really think of ourselves almost like an API type of institution, more like Stripe than Revolut. So we're all about giving our customers, which are businesses, access to their accounts. But we use the blockchain as a technology, and I think it's perfectly compatible. Thank you. Unconditionally redeemable on demand at par value. So is my, well, not just mine, his as well, is we get into trouble if we don't redeem unconditionally on demand at par value.
But you want to be the first one who should get into trouble and didn't get into trouble, though, so, yeah.
No, I prefer not to. I've got kids and all that stuff.
So I'm the e-money institute.
So think of it as a high-grade money market fund with a capital contribution by the issuer, but it's redeemable at par, so the issuer gets to retain the investment income on the underlying securities. Okay. That's how it works. I'll
using like a US dollar as an example, though. If I have a US dollar coin that's regulated as an e-money institution.
Yep.
And the user says, well, I want my US dollars, you have to physically give them the US dollars?
Physically give you, but for our purposes, we're serving businesses, and I don't think they would ever demand cash. We'll just transfer via the appropriate payment system back to your account with your commercial bank.
If you're transferring it, though, through a central bank balance sheet, commercial bank, as redemption, then doesn't that just... Aren't you just technically adding another layer?
No, because users can transfer our claims on a blockchain. So if they transfer our claims on a blockchain, they're not really using the existing payment systems. They're using, for lack of a better phrase, they're using a network of virtual machines in the, they're using cryptography.
Got it.
Well, I don't think the idea of like a backed stable coin, I actually don't think makes a lot of sense. But I mean, the idea of like, if something is rare and scarce, it's not going to be stable in value. So if the thing that's backing the thing that you're issuing isn't stable in value, then how can you have stability on one side of the equation and not the other? But I do think the idea of digital scarcity is a really interesting one, and it's the one that sort of forms the basis of Bitcoin and the use of double use of proof of work in the Bitcoin system, and it's one that is, I think, kind of underappreciated and like as a different avenue for creating a stable coin. Because if you look at like something like Bitcoin and like that whole like in protocol 21 million cap supply thing is kind of artificial, like, and it's also like it's not really scarce, right? Because you could fork the blockchain and change that rule, you know. So the scarcity is all kind of based on like the protocol lasting forever. But like proving to, you know, to the network that you've spent, you know, some kilowatt hours of electricity in order to solve a puzzle, like that is actually genuinely scarce. So if you know, I could sort of imagine a future state where something like the difficulty of solving a block becomes the numeraire of the coin rather than this kind of artificial coin construct. And something like that actually could behave a lot like a lot like a stable coin.
So just a quick follow-up on that though. So if the whatever's backing the coin has volatility, how important is over collateralization? Like make a DAO, so in the DAO system you've got, you know, you have to deposit like twice as much, or if the value goes down by so much, you know.
Yeah, I mean, I think it's like if the backing thing is volatile, like ultimately it's not going to be stable. There's going to be some scenario in the world where the backing stuff falls by so much that your over collateralization breaks, and just the mere expectation of that possibility kind of has its own weird kind of feedback loops in markets. So, like, and the idea of like, you know, like narrow banking and e-money is backed by this thing that is the risk-free asset so long as the central banks don't like screw up price stability, and that's just like a rule. There isn't anything backing. There isn't really anything backing central bank money or fiat currency. So it's sort of like a primitive.
Yeah, I was privileged in many ways in my youth. One of the great privileges of my youth is to be having been raised in a society which had no stable money, which was Iceland in the 70s and the 80s. Currency controls, no stable money. So I was a peaceful form of Venezuela or Argentina or whatever. So the notion of stability and money, I never quite linked the two, but so people have ways around the official money, and I've described one of them, one of those experiments before at a prior conference, Coin Summit here in London. Garrick, you were there, I believe, and you're almost there as well. But it was all about, there was a private company that issued liabilities that people believed were safe, and people started hoarding those as savings. And those were liabilities. It was a construction company, and they were redeemable for ready-mix cement. So they're denominated in cubic meters of concrete, and ultimately somebody paid their taxes with it. So the government accepted this form of money as well. So it was an experiment in the early days of the digital age of one private company in one small unstable economy. But people are inventive and clever. They find all kinds of ways of inventing new forms of money. I'm very supportive of it. I think the digital age makes us even more privileged in being able to avoid instability created by, shall we say, quantitative easing, potential instability that lurks there. So I'm all in favor of experimentation as long as it's transparent and focused and clear and not potentially disruptive society.
Well, and also, I mean, I just would add that, I don't know, anyone here using things like Compound or, any of the DeFi protocols, you can earn a pretty good interest rate on your very boring stablecoins right now on some of these protocols. And I would imagine that if Libra launches, there would probably be similar ways to earn positive returns for people who are looking to use Libra for various market operations. So, it might be boring in one regard, but in Venezuela or on a DeFi platform, it can actually be quite interesting, I would think. And we don't know also all the different tricks that Facebook has in mind for how to make it more interesting for you to use it, what kind of discounts or benefits you gain by using it. Is earning a 3% or 4% discount on Uber enough to make you want to pay with Libra? For some people, maybe that is true. For others, maybe not. I don't know. But, yeah.
Thank you, everyone. My thoughts on that, I just think Libra, or the project, is an identity system at its heart anyway, and I think that's the bigger play. So I think that would be more interesting to see how that plays in, and 2 billion people will happily opt into an identity system. But we'll talk about that next time, maybe. Guys, what's very unusual is that pizza arrived half an hour ago, and you're all sitting here. Normally people sneak up. That is you know, a good validation of the